Welcome to SWAYAM Massive Open Online Course on Public Financial Administration. I am Dr. Vijayakumari Joseph, Associate Professor, Department of Commerce, Madras Christian College. In this video, I will be presenting about the meaning, principles and advantages of a budget. A budget is a statement containing a forecast of revenues and expenditure for a period of time, usually a year. It is a comprehensive plan of action designed to achieve the policy objectives set by the government for the coming year. A single item of public expenditure or that of a public revenue cannot be judged in isolation, whereas public expenditure is designed to promote welfare. The taxes impose costs on the taxpayers. The welfare and cost utility and disutility of government financial transactions needed to be balanced. The demands for expenditure have to be balanced against the available resources. A budget is therefore a financial plan for rationing scarce resources amongst various demands for expenditure. Over the last few decades, however, budgets have been extremely complex and pervasive. According to Gladstone, they are no longer affairs of arithmetic, but in 1,000 ways go to the root of prosperity of individuals, relations of classes and strength of kingdoms. Thus, the concerns of budget makers are not just financial, that is, producing a balance between expenditure and revenues. Rather, these are economic, political, social and administrative in nature. A budget is a plan and a budget document which is a reflection of what the government expects to do in future. While any plan need not be a budget has to be necessarily a plan. It shows detailed and location of resources and proposed taxation or other measures for realization. More specifically, a budget contains information about plans, programs, prospects, schemes and activities, current as well as new proposals for the coming year. Resource position and income from different sources including tax and non-tax revenues, actual receipts and expenditure for the previous year, economic, statistical and accounting data regarding financial and physical performance of the various agencies and organs of the government. In India, the budget system was introduced on 7th April 1860. Sir James Wilson gave the first budget speech on the Indian financial policy and he was the first Indian finance member. In independent India, Sri R.K. Shanmugam Chetty, the first finance minister post-independence, presented the first budget on 26th November 1947. The budgeting reforms were processed through 5-year plans which later divided into annual plans. The Finance Commission of India developed sound systems of dividing resource among centre and states. The existing system of making budget is an outcome of development through the years. The purpose of making budget by the government is to use the public resource efficiently. The Constitution of India uses the term annual financial statement for the main budgetary document of Government of India. In government budget, the government's plan for expenditures are recorded and then sources to raise funds are identified in order to meet the planned expenditures. The government budget is made for one fiscal year or financial year. In India, the fiscal or financial year of government starts on April 1st and ends on March 31st the next year. For example, fiscal or financial year 2019 to 20 started on April 2019 and ended on 31st March 2020. The period of April to March as a financial year was introduced in India from 1867. Before that, financial year used to commence on May 1st and end on 30th April. The L.K. Jha Committee was appointed in May 1984 to look into the matter of financial year. The committee recommended the commencement of financial year from January because of the impact of southwest monsoon on the Indian economy. The committee also recommended that despite the benefits of change in financial year, it would be better to continue with the existing financial year to avoid many problems. A government has to spend on social welfare, defense, subsidies, maintenance of law and order, and many other development activities. Its source of income are mainly taxes and then through different fees and collection of fines or penalties, divided received by public sector and any interest income received from the funds lent to state governments. A government budget is an annual financial statement showing item-wise estimates of expected revenue and anticipated expenditure during a fiscal year. According to Article 112 of the Indian Constitution, the Union Budget of a year, also referred to as the annual financial statement, which is a statement of the estimated receipts and expenditure of the government for that particular year. In other words, government budget is a legal document passed by the legislature of India and approved by the chief executive or president of India. The basic elements of a budget are the revenues and expenses. The basic purpose of a government budget is to make optimum allocation of scarce resources considering the socio-political considerations. The following is important to know about the government budget in India. The Union Budget of India, which is also known as General Budget. It is present each year on the last working day of February. It is presented by the Finance Minister of India to Parliament. Article 112 of the Constitution of India speaks about presentation of annual financial statement of government in Parliament. The Union Budget of India, which is represented through 14 documents. The budget preparation in India is an iterative process between the Ministry of Finance, Planning Commission and the spending ministries. A budget is, however, not a balance sheet of the government on a particular date but refers only to information explained above. It is a financial blueprint for action and is therefore of great advantage to government, departments and legislatures and citizens. The main elements of a budget. It is a statement of estimates of government receipts and expenditure. Budget estimate is also a fixed period generally for a financial year. Expenditure and sources of finance are planned in accordance with the objectives of the government. It requires to be approved by Parliament or Assembly or some other authority before its implementation. There is no set formula for categorizing the budgets. It depends on the practice and requirement of a specific organization or sovereign how they want to classify the budgets. In India, the following are more popular types and forms of budget which is in practice. Balanced budget. As the name suggests, a balanced budget is a budget in which revenues are equal to expenditure. This implies that taxes on income and expenditure etc. are sufficient to meet payments for goods and services. However, balanced budget is not an ideal type of budget as argued by economist John Maynard Keynes. Second one is the revenue budget. Revenue budget includes the government's revenue receipts and expenditure. There are two kinds of revenue receipt, tax and non-tax revenue. Revenue expenditure is the expenditure incurred on day-to-day functioning of the government and on various services offered to citizens. If revenue expenditure exceeds revenue receipts, the government incurs a revenue deficit. Performance budget. It is also called outcome budget. This is prepared by all the ministers who deal with development activities of the nation. This type of budget is specifically preferred for major central sector project programs. It also includes the performance of each public sector working in India. Zero-based budgeting, which is a type of budgeting which has no base. It starts the making of budgets from scratch. It requires the managers to justify each and every transaction made in zero-based budgeting. Generally, Zero-based budgets are used as a supplementary to the traditional system of budgeting. Capital budget includes capital receipts and payments of the government. Loans from public, foreign governments and RBI form a major part of the government's capital receipts. Capital expenditure is the expenditure on development of machinery, equipment, building, health facilities, education, etc. Fiscal deficit is incurred when the government's total expenditure exceeds its total revenue. The document provides an abstract of receipts at the very beginning, followed by details of tax revenue, non-tax revenue and capital receipts. The receipts budget estimates the receipts included in the objectives of budget. Accountability. In the early phase, legislative control and accountability were the primary functions of the government budget. This arose from the legislature desire to control tax proposals and spending. The executive was accountable to the legislature for spending within limits approved by the latter under several heads of expenditure and only for approved purposes. Similarly, accountability was to exist within the extensive on the part of each subordinate authority to the one immediately above in the hierarchy of delegation. Accountability continues to be an important function of the government budget even today, owing to its usefulness in budget execution and plan implementation. Budgeting is an executive or managerial function. As an effective tool of management, budgeting involves planning, coordination, control, evaluation, reporting and review. Many of the budgetary innovations such as functional classification, performance measurement through norms and standards, accounting classification to correspond to functional classification, costing and performance audit and use of quantitative techniques which have become important aids to management. Various budgetary systems like performance budgeting and zero-based budgeting are specifically management-oriented systems. Control essentially implies a hierarchy of responsibility embracing the entire range of executive agencies for the money collected and expenditure within the framework of overall accountability to the legislature. In a democracy, control which assumes new dimensions and give rise to exceedingly difficult problems. The basic concern in a truly representative government is to bring about suitable modification in the design and operation of the financial system so as to ensure executive responsibility to the legislature, which is the law-making, revenue determining and fund granting authority. Legislative control would mean that the legislature can meaningfully and not merely formally participate in the formation of broad policies and programs, their scrutiny, approval and implementation through the annual budget. It also means that the legislature can effectively relate performance and achievement of the executive to the objectives and policies as laid down by it. Members of the legislature are not always adequately acquainted with the complexities of financial administration, nor can they always understand the enormity of the vast scale of operation and therefore the level of funds required. Various devices are therefore used to assist legislatures in exercising their legitimate powers over the executive. The Congressional Committee of the United States and the Parliamentary Select Committees of the United Kingdom help India, the legislature, in the exercising their control over the public purse. We shall be discussing in detail about the role of financial committees in Unit 19 of Block 6 of this course. Statutory audit also examines the accounts and other relevant records to ensure that the monies granted by the legislature are spent strictly in accordance with law. Also, audit tries to ensure that the government obtains value for the taxpayers' money and that the norms of economy, efficiency and effectiveness are observed. Planning. Budgeting provides a plan of action for the next financial year. Planning, however, involves the determination of long-term and short-term objectives, determination of quantified targets, fixation of priorities. Planning also spans a whole range of government policies, keeping the time factor and interrelationship between policies in view. Planning envisages broad policies choices which is at the level of projects and programs. The choice is between alternative course of action so as to optimize the resource utilization. The goals of public sector are optimal allocation of resources, stabilization of economic activity, and equitable distribution of income. The promotion of economic growth are all pursued in an organizational context. In the short run, achievement of these goals has to be coordinated by means of administrative and legal instruments, among which budgetary policy and procedure are the most important one. Planning in the budget process reflects political pressures as well as financial pressures and financial analysis. Principles of budget. The principle of annuality. The principle of annuality implies that a budget is prepared on annual basis every year. A year is considered an ideal period for budget as it is an optimum period for which the legislature can give financial authority to the executive. Also, this is ideal for the executive, which needs time to ensure effective implementation of budget proposals. Furthermore, a year corresponds with the customary measures of human estimates. Rule of lapse. The rule of lapse implies that the money left unspent in a year must also lapse to the public treasury. The government should not be able to spend the amount unless it is re-sanctioned in next year's budget. This measure is used as an effective tool of financial control. Fiscal discipline. A budget should be balanced and there should be congruence between income and expenditure. This is known as fiscal discipline. This concept adheres to the Keynes school of thought. Balanced budget estimates fiscal deficits and offset fiscal surplus. Inclusiveness. A budget should be inclusive, that is, it should take into consideration the diverse budget estimates. An inclusive budget includes all the government revenue and expenditure. It also helps evaluating the much needed trade-offs between different policy options. Accuracy. The budget figures should be accurate and precise. These figures are generated by the finance minister on the basis of data and material from various departments. Budget figures are primarily predictions of the amount of money that is to be generated in the forthcoming year and the expenditure. Transparency and accountability. As per the United Nations, budget transparency and accountability are among the 8 basic indicators of good governance. Budget transparency implies that the government should provide all the data that relates to the budget. These two traits of budget also involve ethics on the part of the government. For the sake of clarity and transparency, the revenue and capital portion of the budget are kept separate. Various forms are systems of budgeting. 6 forms are systems of budgeting which have evolved over a period of time are explained below. Line, which is the item of budgeting. This is also called a traditional budgeting or a conventional budgeting. This system of budgeting was developed in the 18th and 19th century. It emphasizes on the item of expenditure without highlighting its purpose and conceives budget in financial terms. Under this system, the amount granted by the legislature on a specific item should be spent on that item only. The objectives of this budgeting are to prevent wastage, overspending and misuse of money granted by the legislature. This system of budgeting facilitates maximum control of public expenditure. In fact, the sole object of line item budgeting, which has been the accountability of funds, that is, ensuring legality and regularity of expenditure. Performance budgeting. The system of performance budgeting originated in the USA. The term performance budgeting was coined by the first Hoover Commission 1949. This commission recommended the adoption of performance budgeting in the USA to make effective management approach to budgeting. Accordingly, it was introduced in 1950 by President Truman. The advantage of the performance budgeting are as follows. It presents more clearly the purposes and objectives for which the funds are sought by the executive from the parliament. It brings out the programs and accomplishes on financial and physical terms. It facilitates a better understanding and a better review of the budget by the parliament. It improves the formulation of budget. It facilitates the process of decision making at all levels of government. It increases the accountability of the management. It provides an extra tool of management control of financial operations. It renders performance audit more purposeful and effective. Programming budget. Like performance budgeting, program budgeting, which is also known as planning, programming, budgeting system, which also originated from USA. It incorporates a scheme of planning in the budgeting process. Program budgeting, or which emphasize the planning aspect of budgeting for selecting the best out of a number of available programs and for optimizing the choice in economic terms while allocating funds in the budget. It treats budgeting as an allocative process which is among competing claims to be conducted by using the relevant planning techniques. Advantages of budget: management and control. A budget provides a strategic plan of action. It creates a caution over the expenses that can be borne by the institution or an individual. It therefore helps to check and make decisions on the basis of their capacity. Evolution of policies. A budget allows an evolution of the goals and policies which are set as guidelines for taking further decisions over the spending. Capital reinforcement. With a good budget, a company or an individual can make the best use of their individual resources and capital wherever they can be applied for more productivity and profit. Promotes competition. A budget can help in effective competition between organizations and individuals if they are well aware of their financial status as well as are able to make an adequate estimation on their activities and operation to earn profit. Systematic and organized. The approach of a budget is very systematic and disciplined while ensures successful study and implementation of the plans and actions of the company or individual. Constructive. A budget does not allow any of the resources or money to go wasted, as it provides a guideline to follow to make use of them constructively. The disadvantages of a budget: inaccurate and unrealistic. A budget is based on assumptions and judgments. If there is any change in the business plan or implementation, the whole production over the budget plan will get affected. The result of a budget plan, therefore, are always unpredictable and can be inaccurate sometimes. Inflexible. A budget is formed depending on certain policies of an institution or goals of an individual that leads to decision making. However, if there is any need to review their financial status considering any change in the market, there is no way the budget can be altered. Finance oriented. The budget does not support the interest and requirement of the people. It is more profit oriented, which is more quantitative, while the needs of the people are more qualitative in nature. Time consuming. The process of planning a budget or budgeting is a time consuming affair. It needs to consider all possible aspects of an organization or an individual before ensuring any expenditure or spending towards a particular goal. Conflicts. The failure of a budget can result in a lot of arising tensions and rifts within the company that ultimately get reflected by the inefficient running of the organization. Zero-based budgeting. Zero-based budgeting is an approach to making a budget from scratch. The budget is not based on previous budgets. Instead, the budget starts at zero. It involves re-evaluating every line item of cash flow statement and justifying all the expenditure that is to be incurred by the department, which is justified for each new period. The process of zero budgeting starts from zero base, and every function within an organization is analyzed for its needs and cost. The budgets are then built across what is needed for the upcoming period, regardless of whether each budget is higher or lower than the previous one. Thus, zero-based budgeting definition goes as a method of budgeting whereby all the expenses for the new period are calculated on the basis of actual expenses that are to be incurred and not on the differential basis, which involves just changing the expenses which is incurred, taking into account change in operational activity. Under this method, every activity needs to be justified, explaining the revenue that every cost will generate for the company. There are steps in zero-based budgeting: identifying the decision units that need a justification for every line item of expenditure in the proposed budget; preparation decision packages. Each decision packages is an identifiable and separate activity. These decision packages are connected with the objectives of the company. The next step in zero-based budgeting is to rank the decision packages. This ranking is done on the basis of cost-benefit analysis. Finally, funds are allocated on the basis of the above findings by following a pyramid ranking system to ensure maximum results. Therefore, the difference between the traditional budgeting and zero budgeting: number one, in traditional budgeting, the previous year's budget is taken as a base for the preparation of a budget, whereas each time the budget under zero-based budgeting is created, the activities are re-evaluated and thus started from scratch. Second one, the emphasis of the traditional budgeting is on the previous expenditure level. On the contrary, zero-based budgeting focuses on forming a new economic proposal whenever the budget is set. Traditional budgeting works on cost accounting principles, thereby it is more accounting oriented, whereas the zero-based budgeting is decision oriented. Fourth one, in the traditional budgeting, justification of the line item and expenses are not at all required. On the other hand, in zero-based budgeting, proper justification is required, taking into account the cost and benefit. In traditional budgeting, the top management takes decision regarding any amount that will be spent on a particular product. In contrast, in zero-based budgeting, the decision regarding the spending a specific sum on a particular product is on the managers. Zero-based budgeting advantages: efficiency. Zero-based budgeting helps a business in the allocation of resource efficiency, as it does not look at the previous based budget, instead looks at the actual numbers. Accuracy. Against the traditional budgeting method that involves mere some arbitrary changes to the earlier budget, this budgeting approach makes all departments re-look every item of the cash flow and compute their operation cost. This methodology helps in cost reduction to a certain extent, and as it gives a true picture of costs against the desired performance. Budget influence. As mentioned above, every expense is to be justified. Zero-based budget compensates the weaknesses of incremental budgeting of budget inflation. To conclude, zero-based budgeting disadvantages: high manpower turnover. The foundation of zero-based budgeting itself is a zero. Budget under this concept is planned and prepared from the scratch and require the involvement of a large number of employees. Many departments may have adequate human resource and time for the same. Time consuming. This zero-based budgeting approach is a highly time intensive for a company to do annually, as against incremental budgeting approach, which is a far easier method. Lack of expertise. Providing an explanation for every line item and every cost is a problematic task and requires training for the managers. Zero-based budgeting targets at presenting true expenses to be incurred by a department. Although this budgeting method is time consuming, this is more appropriate way of budgeting. This includes all-inclusive analysis of the budget proposal, and if the managers make irrelevant variations so as to achieve what they want, they are probably exposed. Thank you.